Good morning, real life traders. I am Brad Reed. I am a real life trader, and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. I have the blessing of being joined by my dad, Ed, in Austin, Texas. How's it going, Dad?
Good morning, Bradley. Good morning, real life traders everywhere. Going great. This is an excellent day to be an RLT trader.
Absolutely. And I got a good buddy, Art, out in Salinas, California. What's going on, Art?
Hey, good morning, everybody.
So we were looking at some stocks. Okay, wanted to talk to you guys about a drive I made from Chicago back to Indianapolis. So I was up in Chicago a while ago visiting with some real life traders. And on Saturday morning, I was driving back to Indianapolis and I was listening to a radio show, and this guy was talking about I forget what he called it, but some type of indexed investment that was guaranteed not to lose money. I'm sure you guys have heard about this. They advertise it as the market goes up, you share in the gains, but if the market ever goes down, you are protected and you do not experience any losses. And so the question is, Brad, how does that work? Actually, I can put that line back. So what they do is they use something called a trailing stop. And just about any broker would be able to do this for you. But a trailing stop basically says that if the stock or ETF or whatever you're trading goes down a certain amount, then it closes you out. So it can go up and up and up. And let's say your trailing stop is set for 5%. If the stock goes from 100 to 110 and then retraces 4%, you're still in. If it continues upwards to 120 and then goes down 3%, you're still in. If it goes up to 130 but then goes down 6%, well, it'll get you out at your limit there of 5%. And if you immediately start into a position, say at $100, and it goes down to 95, well, then it just gets you out immediately. So what happens with these type of investments are if the stock does go up or ETF does go up 5%, they may give you 1% of that, and then they keep the 4%. And if the stock goes up maybe 10%, then they'll give you 3% or 4%, and they'll keep the other 6 or 7%. And if it goes up to 20%, then they may give you 7 or 8 or 9%, and they keep the majority. And by doing this, when the market goes up, they're making more money than you are. So if the market ever does go down, they can cover whatever losses you would experience between before your trailing stop triggers. Now, on the other hand, some of these, they advertise you are protected from the downside, but then when you go and see the fine print, they say, in any 1 year, your maximum loss would be 4%. And then they give you a sales pitch about why, investing is risky, but this is protecting your downside, blah, 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 blah. So this is how those things work. So if we were to say on the S&P 500 here, let's say we have a trailing stop. Let's say instead of 5%, we say it's 10 points. If it ever goes down 10 points, then we'll close out our position. And so we get in. Let me adjust my picture here a little bit. There we go. Come on. All right, so let's say we get in at the very top right here. All right, market formed this little head and shoulder-ish type thing, or maybe that's a double top. And it goes from 135 down to 125, and that's when our stop order triggers, and it keeps on going down here, blah, 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 does this bouncing action, and we see this as certainly a great bottoming pattern. So we get in again, and it comes up here to 130, and then comes back down. Let's see, I guess that did go down to 115. So we got stopped out again. Then it comes up here to 125, and we say, hey, let's get in again. It comes down here to 120. We had a 10-point moving stop, so we're still in. Then it comes up here to 141, And it comes down here to 136 and we're still in. But right now, since the high is 141, we have a 10-point moving stop. Our trigger point will be 131. And so we come down here to 131 and we're out at 131, but we got in at 125, so we made $6. It forms this inverted head and shoulder thing there, and so we get in at 134. It does come down to 131, but it ends up going up here to 147. And then we'd get out at 137. So we got in at 131 and out at 137, and so on. And it keeps doing this over and over and over again. And this is how the traders there are trading your account. But realize when it goes up, they keep most of it. But when it goes down, you don't have any losses. So for people that have a real life trading education, they're thinking, well, why not make money in the downside too? And that's great. But I've talked to a few people here recently working on their retirement planning. They're close to retirement, and they have achieved what they need to hit their retirement dreams. So I think one of these investments might be a decent opportunity for you. However, if you just learn how to set your own trailing stop, maybe on this one, 10 points is too tight. Maybe you want to set it at 15 points, and then you get in on all these swings, and you would... I guess you would have stayed in on this big one that happened just a while ago. But you know, you could look at the chart, you could back trade it. Oh my gosh, didn't I talk something about a 7 steps to your own trading strategy? You can find that on the website. I guess now I have to talk about it, don't I? I do have a strategy on 7 steps to developing your own trading strategy. If you go to reallifetrading.com, click on articles, it's this one right here, 7 steps to building your own trading strategy. And basically what that's going to tell you to do is to go back in time and practice your strategy. And then you can figure out if you want a $10 moving stop, if you want a 7% trailing stop. Sorry, I said moving stop. I should have said trailing stop. But you can figure out what type of trailing stop you want. Now, the benefit of this is versus doing one of those indexed thingamajiggers where they guarantee you against any losses is, with a trailing stop, you still protect yourself from the downside, but you get all of the upside. So with just a little bit of studying, you can develop your own strategy, plus you don't pay commissions or fees or anything like that. You can do it yourself. So again, the trailing stop is a neat way if you want to be one of those set it and forget it traders where you do get all of the upside and you are protected on the downside. Quick way, easy way to get in and out and capture the gains and protect you from the downside. Questions, comments, or concerns, email me, brad@reallifetrading.com. And for more articles and videos like this, go to www.reallifetrading.com. Thank you very much, everyone, and trade on logic, not on hope.